Welcome back to our channel. If you've ever wanted to invest but thought you needed a lot of money to start, then this video is for you. Today, we're going to explore how to invest with little money in 2024. This step-by-step guide is specially designed for beginners who want to take their first steps into the world of investments, even on a limited budget. So, if you're ready to learn how to make your money work for you, keep watching to find out how to start your investment journey successfully. Amidst rising inflation, stagnant wages, and the ever-increasing cost of living, saving money can be difficult, and maintaining those savings can be even harder. That's where investing comes in. In a challenging economic scenario like the one we're currently facing, investing becomes not only a smart option but often a necessity to ensure a secure financial future. But before we dive in, don't forget to like the video, leave your comment, and subscribe to the channel to stay always updated. Thank you. A journey of investment can start with as little as $1. That's right, a single dollar can be the starting point to build your wealth in the long term. All you need is a willingness to learn and a cool head on your shoulders. Everything else can come with time and effort. No matter the size of your budget, there are investment opportunities available for everyone. Here's a step-by-step guide on how to invest even if you don't have much money. Step 1. Understand the basics of investing. Starting your investment journey doesn't require having a robust bank account. It's about making... Before we continue the video, allow me to introduce an offer that can completely change your financial trajectory. Access the link in the description below and discover an extraordinary opportunity to earn money significantly and sustainably all through the internet. Don't let this chance slip away. Smart choices with what you have. When it comes to investing with limited funds, knowledge is your most valuable asset. Before diving into any investment, it's crucial to understand the basics. This means familiarizing yourself with terms like stocks, bonds, ETFs, exchange-traded funds, and mutual funds. A solid foundation in these areas can help you make informed decisions and set realistic financial goals. Another key to investing on a budget is consistency and patience. Starting small doesn't mean staying small. By regularly contributing to your investments, even in small amounts, you harness the power of compound interest, which can turn modest savings into significant sums over time. Avoid common pitfalls, such as chasing high returns without understanding the risks of investing in trendy assets without doing your homework. Remember that every investor's journey begins with a single step, and with the right approach, even the smallest step can lead to substantial growth. Stay informed, disciplined, and watch your investment portfolio grow $1 at a time. Step 2. Prepare to invest. This step can be completed before and during your investment journey. It's a great practice for anyone looking to be savvy about their finances, which starts with effective budgeting and saving. The first step to unlocking investment opportunities is managing your current finances wisely. This means carefully examining your income and expenses to identify where you can cut back and save. Many find success by adopting the 50/30/20 rule, allocating 50% of income to needs, 30% to wants, and 20% to savings and investments. This simple yet effective strategy can help systematically set aside funds for investment purposes. Equally important is establishing an emergency fund before diving into investing. Life's unpredictability calls for a financial cushion, typically covering 3 to 6 months of living expenses, to handle unforeseen circumstances without derailing your investment journey. This fund acts as a financial safety net, ensuring you won't have to prematurely liquidate investments, which can be counterproductive to your investment goals. Step 3. Start small. There are many different ways to start investing with little money. Investing doesn't always begin in the high-risk world of the stock market. Sometimes, it starts with a simple and safe foundation, such as a high-yield savings account. These accounts are an excellent starting point for new investors, offering a risk-free method to grow savings at higher rates than traditional bank accounts. Especially for those who aren't yet ready to navigate the complexities of the stock market or individual stocks, a high-yield savings account can be a springboard that provides a taste of passive income through accrued interest. Furthermore, consider exploring investment apps that allow investing small amounts in fractional shares, where you can buy a portion of a stock at a time. These apps often have integrated educational features that can help you better understand the market while building your portfolio. And remember, there's no rush to invest large amounts. Start small, stay consistent, and watch your wealth grow over time. Micro-investment apps, tailored for those without substantial capital, represent another accessible entry point into the world of investing. These platforms demystify the process, allowing users to invest minimal amounts, sometimes just the spare change from transactions, in a diversified range of investment options, including ETFs and fractional shares of individual stocks. In doing so, they not only provide a practical introduction to investing but also aid in gradually building a portfolio in sync with the user's risk tolerance. Apps like Acorns and Stash stand out for making investing incredibly accessible, blending the ease of saving with the potential for investment growth. The transition from saving to investing may seem daunting, but dividend reinvestment plans, DRIPs, and direct stock purchase plans, DSPPs, facilitate this path. Both allow investors to start small by directly purchasing stocks or fractions of large companies. DRIPs, in particular, offer a way to automatically reinvest dividends received into additional shares, harnessing the power of compounding to increase investments over time. This approach not only fosters an investment habit but also provides direct exposure to the potential returns of the stock market, without the need for substantial initial investment. Active investment versus passive investment. For a beginner investor focusing on growing their savings for retirement or increasing a small initial amount, understanding the differences between active and passive investment can be very important. Active investment involves hands-on management, with investors or their financial advisors making specific decisions on buying or selling stocks, bonds, or other securities based on market analysis. This approach aims to outperform the market average and requires a lot of research, market knowledge, and often higher fees for managed funds. On the other hand, passive investment involves setting a long-term strategy and sticking to it, minimizing the amount of buying and selling. This often involves investing in index funds or ETFs that track a market index, such as the S&P 500. The beauty of passive investment, especially for those just starting with limited funds, lies in its lower costs and the power of compounding interest over time. Online banks and various platforms now offer easy access to these types of investments, allowing monthly contributions from your account to steadily increase your portfolio. Step 4. Explore other low-cost investment opportunities. One of the most important investment rules is that to minimize risks, you need to build a diversified portfolio. The general way to do this is to invest in a balanced combination of high and low-risk assets, as well as assets belonging to different industries. To expand your investment horizon, also consider the possibility of investing in exchange-traded funds, ETFs, representing specific sectors of the economy or investment themes, such as technology, healthcare, renewable energy, among others. These ETFs offer exposure to a wide range of companies within a sector or theme, providing instant diversification and reducing the risk of individual investment. Another option to consider is global market index funds, which offer exposure to companies worldwide. This can help mitigate the risk associated with concentration in a single market or geographic region. Additionally, some global index funds have low management fees, making them an affordable choice for investors with limited budgets. When exploring these low-cost opportunities, always remember to keep an eye on your investment horizon and your financial goals. Diversifying your portfolio and remaining disciplined over time are keys to achieving investment success, even with a modest budget. A good starting point is index funds and ETFs, exchange-traded funds. These investment vehicles are celebrated for their ability to offer diversification at a relatively low cost, an essential factor in building a resilient investment strategy. By pooling money from numerous investors, index funds and ETFs invest in a wide range of assets, from individual companies to entire sectors, reflecting the performance of specific indices. This broad exposure significantly mitigates the risk associated with investing in individual stocks, aligning well with the investment goals of those seeking a more conservative entry into the market. Financial advisors often recommend these options to clients seeking an investment strategy that balances growth potential with risk management, all without the need for substantial initial investment. At the other end of the spectrum is the dynamic world of cryptocurrencies. Investing in digital currencies like Bitcoin and Ethereum has become increasingly accessible, with platforms allowing transactions with just the value tied to a debit card purchase. This low barrier to entry allows investors to explore the cryptocurrency market without committing large sums, making it an intriguing investment vehicle for those willing to navigate its volatility. While the potential for high annual returns attracts many to this frontier, it is accompanied by a much higher level of risk and price fluctuations than more traditional investments, such as index funds or retirement accounts. Financial planners often stress the importance of understanding these risks and rewards, advising that cryptocurrency should complement, not dominate, a diversified portfolio designed to meet long-term investment objectives, including individual retirement planning. Reinvesting dividends is another powerful strategy to enhance your investment journey. When companies pay dividends to shareholders, instead of accepting these payments in cash, you can choose to reinvest them in purchasing additional shares. As you effectively earn dividends on the reinvested dividends, this approach can significantly compound the growth of your investment over time. This is particularly advantageous in employer-sponsored retirement plans or any long-term investment account, where the goal is to substantially increase the investment by the time you reach retirement age. These methods help mitigate the risks associated with market volatility, increase the growth potential of your investments, and ultimately ensure a healthy financial situation when you reach retirement age. Starting on this path as early as possible, even with small amounts, can make a significant difference in the long run, allowing you to navigate your investment journey with confidence. Common investment mistakes to avoid. No matter what your investment plan or strategy is, there are some common mistakes that can stand between you and success. Here are some of them. Investing without understanding. Getting into investments without a clear understanding of how they work is like navigating without a map. Whether it's stocks, real estate investment trusts, REITs, or any other vehicle, solid knowledge is essential. Take the time to research to ensure that each investment aligns with your goals and risk tolerance. Trying to time the market. Many investors think they can predict market highs and lows, but this strategy often leads to missed opportunities. Instead of trying to outsmart the market, consider reliable investment strategies, such as dollar-cost averaging, where investing regular amounts over time can mitigate the impact of volatility. Lack of diversification. Putting all your eggs in one basket is risky. Diversification, spreading your investments across various assets such as stocks, bonds, and real estate investment trusts can reduce risk. Remember that a diversified portfolio can include investments in different sectors, geographical locations, and asset classes. Forgetting the long-term perspective, it's easy to get caught up in short-term fluctuations and lose sight of your long-term investment goals. Keep in mind that building wealth is a marathon, not a sprint. Adjusting your portfolio in response to short-term market movements can be detrimental to your long-term goals. Blindly trusting financial professionals. There are many online advisors who promise to build a profitable portfolio for a small fee or even for free. Don't blindly trust these individuals, there's a good chance it's a scam. Also, be cautious of people who post their investment ideas and plans online, especially if they promise high returns. Conclusion. While it's much easier to start investing when you already have considerable savings in your accounts, it's not impossible to invest when you don't have much money. Regardless of your current financial situation, investing can help you increase your funds and provide you with a safety net. Remember that successful investing doesn't just mean making thousands of dollars. It's about making smart, informed decisions that steadily increase your wealth over time, regardless of the size of your brokerage accounts. Frequently asked questions: how to invest in real estate with little money? Investing in real estate with little money may seem challenging, but it's entirely possible through creative strategies. An accessible route is through real estate investment trusts (REITs), which allow investing in real estate without purchasing physical properties. Crowdfunding platforms are another option, as they allow individuals to pool their resources to invest in larger real estate projects. How can beginners invest in stocks with little money? Beginners can start investing in stocks with little money by taking advantage of platforms that offer fractional shares, allowing them to buy portions of a single stock at a time. This approach makes it easier to invest in high-value stocks without the need for a large initial investment. Additionally, starting with low-cost index funds or ETFs can be a smart way to diversify your portfolio with minimal initial investment. How can taxes affect investment decisions? Depending on your tax bracket, the returns from certain investments can be significantly impacted by taxes. Consider tax-efficient investments and accounts, such as Roth IRAs or 401(k)s, especially if you're in a higher tax bracket. Consulting with a financial advisor can help navigate these waters, ensuring that your investment decisions are growth-oriented and tax-smart. Disclaimer: please note that the content of this video is not financial or investment advice. The information provided in this article is solely the opinion of the author and should not be considered as trading or investment recommendations. We do not offer any guarantee regarding the completeness, reliability, and accuracy of this information. The cryptocurrency market suffers from high volatility and occasional arbitrary movements. Any investor, trader, or regular cryptocurrency user should research multiple viewpoints and be familiar with all local regulations before committing to an investment. I hope this step-by-step guide on how to invest with little money in 2024 has been helpful to you. Remember that starting to invest, even with small amounts, can make a big difference in the long run for your financial security. If you enjoyed this video and would like to receive more content on personal finance and investments, don't forget to subscribe to the channel and enable notifications to not miss any future videos. Additionally, leave a comment below sharing your experiences or questions about the topic. I would love to hear your feedback and answer any questions you may have. Thank you for watching and see you in the next video.